Welcome to This Explainer. Okay, today we're taking a deep dive into the hidden reality behind a highly romanticized, multi-million-dollar real estate portfolio. I mean, for decades, we've all been sold this ultimate financial dream, right? You buy some property, you collect the rent, and you just sit back and watch your wealth effortlessly multiply. Sounds great, but what actually happens when you do everything right on paper? You lock in those historically low rates, you build massive equity, and yet when you finally pull back the curtain, the reality is, well, it's far less glamorous. We're going to unpack a complete investment autopsy today to show you the side of real estate that almost nobody talks about. Just listen to this stark realization from an investor who actually successfully built a massive portfolio. They said, I was taking on a part-time job, except assuming all the liability. I would have made just as much money with the most basic of index funds. I mean, wow, this right here, this is our ultimate plot twist. It completely shatters that illusion of real estate being this passive, stress-free path to early retirement. So how exactly does a massive on-paper success story end up with such deep regret? Let's get into it. Section 1, the perfect on-paper portfolio. Let's look at where it all began, because honestly, the initial success phase of this portfolio was the stuff of legends. Starting way back in 2008, this investor began scooping up rundown, dilapidated foreclosures in Southern California. We're talking the kind of houses nobody really wanted to live in. But over the next several years, they amassed 7 rental properties. They renovated them, got them rented out, and locked in 30-year fixed mortgages at those rock-bottom 3% interest rates. On a spreadsheet, it looks like an absolute masterpiece. To give you a sense of just how humble and really how highly profitable these beginnings were, $59,500. That was the purchase price of the very first bank-owned foreclosure this investor bought in San Bernardino County back in 2011. Sure, it required some elbow grease and fixing up, but it was the exact catalyst that got them completely hooked on the real estate game. Now, contrast that with $400,000. That is the current value of that exact same property. And other properties in the portfolio saw similar explosive growth too. One West Los Angeles home jumped from a $780,000 purchase price to a staggering $1.3 million. When you're seeing a 300% return on a property, it is incredibly easy to get blinded by the success. The rising market was basically doing all the heavy lifting, making the entire portfolio look bulletproof. But here is where we find a massive disconnect. It's so easy to just point to your property's appreciation and say, hey, look how much it's worth. But here's the critical lesson. On-paper equity is completely different from actual cash flow. Appreciation actually means absolutely nothing for your daily life until you sell the property. Meanwhile, the harsh reality of everyday expenses, your insurance, utilities, maintenance, they steadily eat away at the actual cash in your pocket. Section 2, the rent control trap. The investor had what seemed like a really simple philosophy. Lock in a great rate, get a good tenant, never raise the rent, and just enjoy the peace of mind. It was a totally noble desire to be a nice guy landlord, but that desire violently crashed into the harsh reality of Los Angeles rent control ordinances. The compounding effect of this is just brutal. Under rent control, you can only raise rent a tiny fraction each year, and if you skip a year, you can never make it up later. So when the investors skipped their 3% increases prior to 2020, the trap was basically set. Then 2020 hit. Insurance costs doubled, utilities shot up 30%, repair costs surged. Suddenly, these properties were barely breaking even. But because of a city-imposed 3-year ban on raising rents, the investor was completely trapped. And here's the real kicker. Because real estate investors value properties based on the actual income they generate, having rents significantly below market value resulted in a massive $100,000 loss on the final sale price of the property. Literally, being nice cost $100,000. Section 3, the true cost of repairs. Operating costs are wildly unpredictable. And while every real estate guru out there tells you to budget a standard 1% for maintenance, the reality of owning property for over a decade tells a very different story. Imagine opening a bill from your property manager and seeing an $800 charge to fix a ice maker on a refrigerator that's maybe only worth $400 to begin with. I mean, common sense says you just buy a new fridge, right? But when you aren't the one making the immediate on-the-ground calls, these minor, absurdly overpriced fixes just nickel and dime your cash flow to death. And honestly, these nickel and dime repairs mask a much larger danger. You might have 3 or 4 years where everything is totally fine, and you think to yourself, man, I'm a real estate genius. But then it's August. It's the hottest week of the year, the AC unit dies, and the roof springs a leak simultaneously. Suddenly, you're hit with a $20,000 repair bill from literally the only contractor available. In an instant, an entire year's worth of profit on that property is completely wiped out. Section 4, hitting costs of selling. Eventually, the headache just becomes too much, and you decide to exit. But getting top dollar for your properties requires far more than just sticking a for sale sign in the front yard. This number is just staggering. $100,000. That is exactly how much was spent just preparing 3 properties for sale. When a place has been tenant occupied for nearly a decade, you can't just list it as is if you want multiple over-asking offers. You have to pay for deep renovations, landscaping, professional staging, and sometimes you even have to pay a voluntary buyout to your tenants just to get them to move out so you can show the property turnkey. And just when you think you've cleared all the hurdles, the tax man comes knocking. Over the years, the IRS lets you deduct the depreciation of your property's structure, usually over 17.5 years, which makes your income look lower and saves you taxes. It's great, right? But here is the catch. When you exit the game and sell, the IRS demands that money back. It's called depreciation recapture, and they tax those earlier deductions at 25%. Add in state taxes like California's extra 10%, and a massive chunk of your supposed profit just vanishes into thin air. Section 5, the hassle factor. Which brings us to an expense you will absolutely never see on an investor's profit and loss spreadsheet, the unseen weight of actually owning the property. Even if you hire a property manager to take those late-night plumbing calls, you're still the final decision maker. You are dealing with constant passive overhead, shopping for insurance renewals, tracking property tax bills, dealing with city inspections, filing mandatory rent registries, processing utility notices. I mean, none of these are catastrophic on their own, but they're a constant drip, drip, drip of mental energy. It just chips away at your focus, your free time, and your peace of mind. So when it comes to ROI, we need a serious reality check. After you back out the repairs, the vacancy, the insurance hikes, the taxes, and all that passive overhead, the actual real-world return for this investor hovered around 4 to 5% a year. Compare that to a basic index fund or a simple treasury bill yielding the exact same 4 to 5% return, except the T-bill comes with zero stress, absolute liquidity, and zero liability. You really have to ask yourself, why take on all the work and risk of real estate for the exact same payout? Section 6. Lessons for future investors. So what do we do with all this? Let's extract some hard-earned wisdom for anyone out there still considering building their own real estate empire. First up, a crucial, neutral financial lesson before you even think about buying. Optimizing your credit and borrowing power is just as vital as optimizing your property selection. You can find the absolute perfect house, but if your credit score forces you into a higher interest rate, you're going to throw thousands of dollars away unnecessarily. Safely building a positive payment history to secure competitive mortgage rates is an absolute prerequisite to keeping your cash flow healthy. Next, if you are going to play the game, follow these 3 concrete rules. 1. Always raise your rent to the maximum allowable by law, every single year, especially in rent-controlled areas. The math simply requires it. 2. Heavily over-budget for surprise repairs. Add 30 to 50% more to your top line than you think you need. And 3. Heavily factor in the opportunity cost of your time. Because at the end of the day, when you buy a rental property, you are essentially buying a customer service job that just happens to come with property taxes. Which leaves us with one final vital question. Is the hassle factor of real estate truly worth it for you? Look, for some people who have the drive, the proximity, and the mental bandwidth for it, the answer is still yes. But before you get blinded by on-paper equity and the romantic idea of passive income, make sure you thoroughly weigh the true everyday costs. Thanks for joining me on this explainer, and I hope this reality check helps you make sharper, more informed investments in your future.